Thank you. Good morning, everybody. It's great to be here. So today I'd like to talk about where I believe our industry is today and where I think it's going. And we're going to have a little bit of fun. I'm going to make 3 predictions today of things I believe will happen in our industry over the next 15 months. And that maybe next year at Landit Europe, if Peter invites me back, we can do a status check after a year. I made these predictions over 15 months so that even if we're not done by Landit Europe next year, I still have 3 months to make it happen. All right, let's get going. So I think the industry has covered a lot of ground over the last 10 to 12 years. So 10 to 12 years ago, 4 major platforms emerged, really. Zopa in the UK was the first one, then Lending Club and Prosper in the US, and Credit Ease in China. And at the time, it was really looked at as a little bit of an oddity. And so the descriptions you saw in the press were these like websites arranging person-to-person loans. And I think since then, we've really established the industry as an entirely new asset class, as a very legitimate and as probably soon the dominant way of obtaining loans for consumers and small businesses. And so a couple of sort of proof points about how mainstream the industry has become, at least in the US and in other places. So just 4 weeks ago, Goldman Sachs came out, and well, first the fact that Goldman Sachs even launched a marketplace lender, Marcus, is a sign of the industry maturing. But then they came out saying, actually, they believe that their own platform, Marcus, will generate as much revenue growth for Goldman in the next few years as bond trading, which is one of their main businesses. So that shows how they believe the industry will grow and their own effort will be successful. And then just 2 weeks later, Keith Noreika, who's the acting chair of the controller of the currency, the acting chair of the OCC, so the top US banking regulator, came out saying that online lending is a natural evolution of banking. So it could have meant two things by that, either the banks are going to be doing more online lending, or actually the online lenders are becoming the sort of ultimate evolution of banking itself. And that was the latter. So I think it's very encouraging to have the top US banking regulator speak in those terms. So let's look at the fundamentals of online lending as just a state of the industry and like a few things that have been established over the last 10 years and really why it's working. So the first reason why it's really working, why the entire model makes sense, is mostly a cost reduction. It's really using a sort of technology and online delivery to lower costs and also deliver a better experience to consumers and businesses. So I've shown that slide before. It's now a well-established methodology that has been used by Bain and McKinsey to show how much cost reduction the industry is achieving. And depending on the survey, it's anywhere between 400 and 600 basis points of savings. The other reason why it's working is we're able to gather online additional data points that might not be available offline in a branch context. And so that includes the online footprint of the consumer. So we've started years ago using sort of email aging and email popularity to establish that footprint. When we brought in additional payment data that wasn't traditionally part of the credit report, such as utility bill payments, and then we started using more sort of location data to try to understand disparity between different regions, particularly in the context of a free cash flow analysis, which is something that at least a couple of platforms in the US are using, that's SoFi and Upgrade, that are really using free cash flow analysis as a way to take into account expenses other than just the payment of the debt, right? So far we have been pretty good at using credit history, credit attributes, the current credit situation of a user as well as the service of the debt through the debt-to-income ratio, the free cash flow really makes room for things that are more about sort of how much taxes are applied in that particular city and state, the sort of housing expense, and the general cost of living, with very significant disparities in the US with, for example, some cities in South Carolina having a 50% lower cost of living than New York or Los Angeles. All right, so with all this data, we've improved the underwriting. We're able to deliver sort of significant returns to investors. And so, for example, so Upgrade, for one, is targeting an 8% return across the entire platform as an average across the platform, in comparison to the sort of high-yield bonds that are currently returning 5.5%. Granted, the sort of analysis isn't completely apples to apples in the sense that a lot of the other asset classes on that slide have more liquidity. So it's interesting to look at it in the securitization context to sort of normalize for sort of risk and liquidity profile. If you look at the senior tranche of a lot of these marketplace lending deals, which is in black in that slide, you see that for a sort of similar return, similar risk, you get into a very low maturity. So in the BBB or BB rated tranche, you can get a 5% return with a 1 to 2 year duration, which is really much shorter than anything else available. The other sort of aspect of marketplace lending investment that has really been powerful for investors is the fact that it's good portfolio diversification, and there's very little correlation between marketplace loans and other asset classes. You all know how to read a correlation chart. So 1 is a perfect correlation, 0 is no correlation at all. Marketplace lending has a correlation of 0 to 0.2 with most major asset classes. So all this has led to a significant growth in the industry. And so even in the last 2 years, there's still a sort of 87% compound annualized growth, which, so fast growth and credit isn't necessarily a good thing. In the case of marketplace lending, it is a good thing because most of these loans are meant to refinance existing balances that carry interest at a higher rate. So this is a good thing for consumers to be able to lower the cost of their credit. And so I believe, and so that's going to be my first prediction today, I believe that, I love the music, that the growth of online lending will actually accelerate, re-accelerate from here. And it's a rare thing in a maturing industry when the growth rate starts slowing down, like it has in 2016. It's rare to see it go back up again. I believe there are a few factors behind that prediction. Like the sort of entry of two sort of new market entrants like Upgrade and Goldman Sachs, but also I think the conditions that really sort of favor a renewed growth in the US, and we'll talk about that. So, I mean, first, when you look at the outstanding balances on credit cards, right? Which again, in the US for personal loans delivered by marketplace lenders is the #1 use case, is being able to refinance a credit card at a lower rate. So credit card balances have been going up pretty quickly. It's actually only a 5% annual growth rate, but it's a very large base. So a 5% growth rate in this case is $50 billion. So essentially the size of the problem we're trying to solve got 50 billion worse in just the last 12 months. So there's an increasing need for credit card refinancing, which could be a bad news in terms of the health of the US consumer. But actually what's been happening is as credit card balances went up, we've seen other balances come down, including mortgages for a number of reasons. But some of them being favorable, being low interest rates and people paying down their mortgages. And that combined with a decent wage increase over the last few years has led the US consumer to experience now one of the lowest, actually the lowest debt to income or debt servicing ratio ever. So the US consumer is actually doing fine from that standpoint. There are a number of other metrics that show the US consumer is doing well in terms of unemployment, in terms of wage growth. And I believe that's one of the main factors that has really enabled a sustained economic growth in the US over the last 100 months now. So the current economic expansion has been 99 months, which is the third longest in US history. It's still 20 months shorter than the previous period of economic expansion in the 2000s. But in the 90s, sorry. But what's interesting is this research done by Goldman Sachs that shows the likelihood of a recession in the US in the next 5 to 9 months. And that methodology has been pretty accurate over the last 3 decades. And this methodology shows currently a 30% risk of a recession 9 quarters out. And typically, over, again, the last several decades, a 30% reading has corresponded with a recession being, in effect, several years out. So that's positive, pretty optimistic projections there. So the other factor that I think will help marketplace lending, online lending continue to grow and grow faster and be more useful to more people is the emergence of what I call online lending 2.0, which is really a second wave of growth in the industry enabled by a number of things, by our own learnings. We've been at it for 10 years and we all learned a lot, but also by a series of technologies that were just not available 10 years ago, including very modern technology stacks based on microservices that really help compartmentalize each service and make it available as a service and help reuse components. So for example, a document verification or a address verification module will be its own service available through an API and can combine many of these services and create new products. And obviously the emergence of cloud computing that helps reduce cost and improve security, big data that helps generate new variables and better understand the underwriting and the credit dynamics, as well as the blockchain protocol that really helps from a data integrity standpoint. So all these new technologies of coming to maturity of this technology really, I believe, will help in terms of further reducing operating costs and bringing down the cost of credit for consumers. And will also help improve the underwriting, again, through variable generation, through a big data process. But also will help in terms of compliance, of data transparency, and data availability. And these, in turn, will have pretty significant user benefits, both on the borrower and the investor side. So from a borrower standpoint, again, a lower operating cost really helps bring down the cost of credit. But that componentization of services also helps create new products faster, which will bring more convenience to consumers. And we'll talk more in a minute about these new products that are coming on the consumer side. But then for investors, I believe the greater availability of data and our own desire to make that data available. I mean, for example, at Upgrade, we've decided to bring get to a new level of transparency by making the entire credit policy available to investors, as well as the verification procedures, but also ongoing transparency in terms of how the portfolio is evolving, and in terms of the evolution of credit qualities of each borrower in the portfolio, independently from the actual loan performance. So you, as an investor on the Upgrade platform, you'll see if the borrower's credit score on average is going up or down before you even start seeing any impact in the performance of the portfolio. And so this sort of data availability and sort of greater comfort in the integrity through the blockchain protocol, for example, let me just say a word about this. So we're essentially using the blockchain as a sort of data integrity tool by sort of committing to a public blockchain the sort of every transaction, every document entered into the borrower, which essentially creates a immutable and time-stamped record of every transaction in a way that's very, very cost-efficient and very transparent. So all these tools, I believe, will continue to help investors, and that leads me to my second prediction, which is the emergence of a secondary market. I think we've talked about it for long enough. Now it's time to do it. I think one of the platforms might get it done. I think there are a number of ecosystem players like Orchard, PIQ, and DVO1 that are also bringing the data and the standardization in the data that is necessary for securities to be more liquid. We've also worked on, besides actual securitization, we've worked on products like pass-through securities that essentially help an investment bank buy loans from the platform and create a QSIPed sort of security that can be sort of standardized and traded. So I think all the components, all the ingredients are there to make the assets more liquid within the next 15 months. So that's the investor side. On the borrower side, I think there will be sort of major product innovation. So looking at what happened in the sort of last, let's say, call it a couple of decades, there's been what I call the sort of unbundling of sort of banking. So if you look at the 5 sort of major things banks do or used to do, there's sort of really lending, processing payments, taking deposits, helping customers manage their assets, and through a lot of relationship and proximity banking, a lot of sort of good advice being given to the bank's customers. And you've seen sort of many of these businesses being unbundled, and a number of players or fintech players essentially sort of developing an offering that addresses one of these services and getting sort of really good at it and very efficient. So obviously, the emergence of online lending is one of them, but it also actually started with PayPal in '98 that started sort of providing some portion of the payment stack, and then other companies since have continued along that path. There's been sort of no attempt at really taking deposits so far because of the regulatory aspect of it. But then if you look at asset management, all the robo-advisors have done a great job at sort of automating a lot of that. And then there are a number of personal finance companies that are doing a fantastic job at sort of giving people more insight into their credit or helping them with their savings or sort of developing other tools that help them sort of budget and better manage their finances. So all this has been sort of unbundled over the last few years. I think what we've seen recently is the beginning of a rebundling and a reorganization of these services in a way that delivers more value to the user and creates combinations that are really interesting. So if you look at these 5 services again, and you put on the side a number of sort of online lenders and fintech companies, and I apologize for everybody who's not on this slide, just too many of them. These are just examples. So obviously you had Klarna in Europe offering sort of payment and online lending in the context of retail financing, Affirm doing something similar in the US. You had Square actually going the other way around and starting with payments and developing Square Capital as a way of lending to small businesses. Then you had SoFi that and Square, by the way, sort of is applying for a banking charter in the US, which might give them the opportunity to take deposits as well. And then you had SoFi that obviously started with lending, student loan refinancing, and mortgages. Then through acquisitions and organic development started offering asset management services to their users, and is also applying for a banking charter. Then you had Lufax and Credit Ease, actually the two largest online lenders in the world now, both in China, that have pretty much from the beginning offered asset management services to their users. What's different now is they started offering asset management as a way, as a channel, as a conduit to their online platform, but they're now offering asset management to invest in other products as well. So an interesting rebundling there. And Upgrade, obviously you knew it was coming. There was going to be an Upgrade commercial at some point in this presentation, so I'll keep it short. But we've chosen to rebundle essentially the loan products and credit monitoring. So it's not necessarily the one that's going to make us the most money, because the credit monitoring is free. But I believe it's something that will be truly useful for consumers. So we've developed a number of tools that really help right now existing borrowers, but very soon in the next month also declined applicants, where I think it's going to be even more useful. So really understand their credit profile and click a few levels down and understand how much is owed under each line and the cost of each part of their credit and how that quality is trending. And more interestingly, run simulations and say, okay, I'm getting a $10,000 bonus this year. Should I sort of pay down my mortgage, pay off a credit card, and get the impact of that action on their credit quality and their sort of, credit score? And then we launched a couple of weeks ago an entire website. We called it Credit Health Insights, that really delivers a lot of content for free to our users, but to the public at large, also on a few sort of topics. Well, now 16 topics that are being addressed, and there's more being rolled out. That really help consumers better understand the utilization ratio on their sort of credit report, better understand the impact of variable or fixed interest rates, and really start making trade-offs and sort of make better decisions that we believe will help them sort of upgrade their credit and get better at managing their finances. Which, so the whole sort of rebundling idea gets me to prediction number 3, which is that I believe that in the next 15 months, we'll see a major product innovation in online lending and in the combination of online lending and other adjacent spaces in banking. I've always been fascinated by the story of Orville Wright and the Wright brothers, of creating an airplane with spare parts of bicycles. And I think we'll see something similar of different platforms really creating an entirely new product using components, using features, partially thanks to the technology of microservices, of componentization of technology. It will be able to assemble a product that truly delivers unprecedented value to consumers and small businesses, and help customers get access to more affordable credit and save money and deliver a lot of value. Thank you.